This is a video about a sharp little momentum tool called the Adaptive Momentum Oscillator by LuxAlgo. In plain English, it measures how strong the current push is by looking for the biggest price move inside a window you choose. Then it plots that strength around a zero line so you can see when momentum is positive or negative right now. It comes with a color-graded histogram to show raw thrust and a smoothing signal line that adapts so you can read the trend without a ton of lag. If you find value in this breakdown, remember to leave a like. Now, to get it on your chart, head to TradingView, open indicators, type Adaptive Momentum Oscillator, and pick the one by LuxAlgo. Drop it on and you'll see the histogram build under price with a zero center and a smooth signal line running through it. That's all you need to add it. We'll walk through what each part means in a second. This is the Adaptive Momentum Oscillator by LuxAlgo. In plain English, it looks inside a window you set and grabs the single biggest price move to gauge peak momentum, then plots that strength around a zero line so you can see positive versus negative pressure right now. The raw read shows up as a histogram and a smooth adaptive signal line rides through it so you can track direction without a ton of lag. It's unbounded, so the farther it gets from zero, the stronger the push you're dealing with. Now, here's how to read the components you'll see on screen. The histogram is color-coded for instant bias. When bars sit above the zero line, they're teal to show bullish momentum. When they sit below it, they're red to show bearish momentum. You'll also notice thin divergence lines drawn at the peaks and troughs of the histogram. Bearish divergences are marked by thin red lines when price pushes up but momentum doesn't confirm. And bullish divergences are marked by thin teal lines when price pushes down but momentum refuses to make a new low. The adaptive signal line is the smoother overlay that filters noise and helps you confirm shifts a bit more confidently. Because the tool is unbounded, a big positive value is simply stronger than a small one. Same idea below zero on the downside. Let's pop into input so we're working with your exact setup. I'm changing data length to 100 so the oscillator captures a longer-term picture of momentum rather than just the last few bars. I'm keeping smoothing length to 9, which is the default here, and strikes a nice balance between speed and stability. For divergences, I'm turning the feature on and setting the divergence length to 10, so we're checking a short but meaningful window for conflicting highs and lows between price and the oscillator. In the Style tab, I'm not changing anything. Click OK. Next, let's go over how we can use this indicator to trade.
Let's talk about Go Login, a powerful tool for managing your digital identity. We all know that running multiple accounts online, whether for different trading strategies, e-commerce stores, or ad campaigns, can be a nightmare. Platforms are smart. They link your accounts, leading to restrictions or even bans. This is the exact problem Go Login is designed to solve. Go Login is a powerful anti-detect browser that lets you create numerous browser profiles, each with a unique, authentic digital fingerprint. You can assign different proxy IPs with a single click, making each profile appear as a genuine, separate user from anywhere in the world. As you can see, each profile passes identity checks, ensuring your accounts remain unlinked and secure. This is a game changer for safely managing multiple accounts without getting flagged. For any serious trader or online entrepreneur, it's an essential tool for privacy and scale. Give Go Login a try with the link in the description below.
All right, back to how we trade with it. The first use is simple momentum bias. When the histogram and signal line are living above zero and the bars are teal, I'm only looking for long positions. When they're below zero and the bars are red, I'm only looking for short positions. Keeping your trades on the same side of zero keeps you aligned with the current push and stops you from fighting momentum. Second use adds a helper for entries. Open the indicator search tab and type Volatility Momentum Score, then pick the one by LuxAlgo. This tool blends price and volatility into a momentum score and can print long and short signals when momentum shifts, which makes it a clean partner for our LuxAlgo oscillator. Once it's on the chart, open its settings and head to the Style tab. We're going to disable everything except the buy signal and the sell signal. Turn off the average Z-score, turn off the plot lines, turn off the candle color, and turn off any overbought or oversold visuals. Click OK. The lower panel will basically disappear, leaving only the buy and sell labels on your chart. Now the plan is straightforward. When the Adaptive Momentum Oscillator is above zero and teal, I'm only looking for buy labels from VMS. When it's below zero and red, I'm only looking for sell labels from VMS. That way the LuxAlgo tool handles direction while the VMS label handles timing. A quick flow you can copy goes like this. In a bullish phase with the signal line holding above zero, wait for a real pullback. Price dips and the histogram briefly flips red under zero for just a few candles, think about 3 to 8 bars, then quickly snaps back above zero to teal. The long trigger is right after that reclaim, ideally as a buy label from VMS fires. Take the long, tuck your stop below the most recent swing low, set take profit at 1.5 times risk, let it run, and as you can see on clean examples, it was profitable. Flip it for shorts. In a bearish phase with a signal line below zero, let the histogram briefly flip teal above zero for 3 to 8 bars, then wait for it to roll back under zero to red and for a sell label. Short with your stop above the swing high and target 1.5 times risk. If a divergence prints against your idea, thin teal lines warning during a down move, or thin red lines warning during an up move, either scale down or wait for stronger confirmation before pulling the trigger. The third method layers in divergence with a lightweight signal partner for timing. Here's the flow for a long. First, spot a bullish divergence on the Adaptive Momentum Oscillator. Look for that thin teal or green divergence line where price makes a lower low, but the oscillator refuses to make a higher low, meaning price is pushing down while momentum refuses to confirm. Immediately after that divergence prints, wait for the next buy label from VMS and take the long. For a short, do the opposite. A thin red divergence line marks a bearish divergence where price makes a higher high, but the oscillator makes a lower high. Once that prints, take the next sell label. For risk, place your stop under the most recent swing low on longs and above the most recent swing high on shorts. Target 1.5 times risk, let the trade run, and as you can see on clean examples, it was profitable. In summary, the Adaptive Momentum Oscillator blends an aggressive core, maximum price delta for raw thrust, with a smart smoothing layer that keeps lag low. The histogram shows acceleration, the signal line shows direction, and the zero line keeps the bias obvious. Tweak the lengths to match your market, use divergence for context, and let structure and volume confirm the actual entry. This is not financial advice. Everything here is educational, and the indicator alone is not a complete strategy. Add your own confluence, price action, higher timeframe context, key levels, volume, and risk management, and make your own decisions. If you found value in this video, remember to leave a like, or even better, consider subscribing to stay tuned. Thanks for watching.